Angel investors and venture capital. These are two outside sources of equity that could provide funding options for your business. My name is Jane Rich, and I am a business advisor with the Northeast Indiana Small Business Development Center. In this session, we'll help you understand the definitions, roles, and purposes for outside investors, including angel investors and venture capital. We'll help you learn the cost for obtaining the outside investment and help you discover what you should expect from an angel investor or venture capitalist and what they will expect from you. What are angel investors? What's venture capital, and how are they different? A formal definition of an angel investor, which is also known as a business angel or an informal investor, is typically an individual who is affluent, who provides capital to a business for startup, usually in exchange for some type of debt that might be converted into ownership or might be provided for ownership. Venture capitalists, on the other hand, are formal structures. They are typically investment firms, and they're also known as VCs or venturists, and they're a type of private equity capital for early stage, high growth, high potential companies that offer a very high return through an eventual realization of an initial public offering or being sold to a much larger competitor. Angel investors, let's talk about them first of all. Angel capital can help fill a gap when a business is starting up between what is needed to start the business and what the owner, family, and friends can provide in the form of their seed funding or equity capital. With angel capitalists, they typically have funding available somewhere under $1 million. That's different than what a traditional venture capitalist would be able to offer, because typically those firms are looking at transactions in excess of $1 million or $2 million. So an angel investor or angel capitalist is an individual as opposed to a firm who's offering smaller amounts of money for an ownership position or a convertible debt position to help fill the gap between what the owner can put in and what the business needs. Angel investors are also common as a second round of financing for high growth startups, filling the gap between traditional venture capital funds and what the business has been able to generate in its own operations. Venture capitalists are a much more formal structure. It's typical for venture capital investors to identify and back companies that are in high technology industries. They also are typically a subsidiary of or affiliated with institutional investors, pools or pooling of high net worth individuals who are brought together by dedicated investment firms. Venture capital firms typically have teams of individuals within the organization that will evaluate an investment opportunity. They typically have technology backgrounds, very strong business training, or deep direct industry experience to help identify technologies that have the potential to generate early returns in the commercial process. Venture capitalists also take a role in managing the day-to-day operations of that business they're investing in, adding appropriate skills to the daily operations as well as the capital. They do get their hands dirty, they do step in and get involved in the day-to-day operations. In venture capital financing, funding, angel investors and venture capitalists require and demand a generous return for their involvement in the transaction. They are sharing in the risk at an ownership level, and they don't have business assets as collateral for what they're providing. Investors, as angels or venture capitalists, typically want a return of between 28 to 32% on their investment or more. They also are going to require an ownership position typically in the business, and that ownership position is negotiated and can exceed 50%. If it's less than 50%, they may have unique or separate voting rights or maintain a different class of ownership for the investment. Businesses that do require angel investors or venture capitalists have to be willing to give up ownership of some amount and must be willing to have limited or restricted managerial rights. They also must provide a written plan and projections to the potential investor and have identified the exit strategy for that investor, showing them what kind of a return at a minimum they can guarantee. And that return should be at least 28 to 32%. That's a much higher rate than what an interest rate for a bank loan would be, wouldn't you say? Proceed with caution. Angel investors and venture capitalists need to know who you are by reviewing your business plan, but you need to know who they are. You need to be able to check them out, verify that they are legitimate, and understand their role and relationship that they anticipate with you. If you have any additional questions about getting ready to apply for a loan, please feel free to contact me. Again, it's Jane Rich, Business Advisor with the Northeast Indiana Small Business Development Center, and our office number is 260-481-0500, and my email address is jrich@isbdc.org.